Morning, good afternoon, good evening, wherever you are in the world. Welcome to this new session of the Financial Statement Series at the Peterson Institute for International Economics. I'm Nicolas Véron, and it's my great pleasure today to welcome Davies and Pervenche Beres to discuss the outlook for Basel compliance. The Basel standards for bank capital liquidity and many of the other things are a recurring theme of this series, Financial Statements. About a year ago, we had two sessions in a row, particularly about the debate on US adoption. We will debate that again. I should mention that in a month's time, Stefan Ingves, who was a long time chair of the Basel Committee, will be my guest, and we will discuss the mechanisms the Basel Committee has for compliance, or as they call it, regulatory consistency assessment, compliance of individual jurisdictions with the global standards of the Basel Committee. So today we will discuss, we will take a global view also with this issue of compliance and alignment. Dan Davies is one of the most prolific and well-respected and well-known equity analysts with really focus on bank capital. So that's what we may call bank capital nerds. I hope that's not inappropriate, Dan. He studied at Oxford until 1994, got a later Master of Science in Finance at the London Business School, started his career at the Bank of England in the 1990s, which he left in 98, and then spent a number of years in the financial industry in a number of securities firms and investment firms, some of which don't exist anymore, including Robert Fleming, ABN AMRO in London, Cazenove, Exane, and Credit Suisse between 2007 and 2011. Then again Exane, which by then was Exane BNP Paribas until 2014. And since then, Dan has been a consultant, author. He has also been affiliated with Frontline Analysts since 2015. That's a research outsourcing company. Sorry, I don't think the Peterson Institute counts as a research outsourcing company, starting from the fact we're not a company. But also commenting a lot on bank capital issues on Twitter, now X, and a number of other media. He has been the author or co-author of a number of books, including The Secret Life of Money with Tess Reed in 2015, Lying for Money, How Fraud Makes the World Round. Sorry, How Fraud Makes the World Round in 2018. And sorry, I don't think I got the title right, but you will correct me. But more importantly, the most recent one, An Accountability Machine, Why Big Systems Make Terrible Decisions, which was published in the UK earlier this year, and it's forthcoming in the US. Dan was also the author, and this actually was the starting point for this episode, of a column in the Financial Times last month, or in September, which was titled "The US Has Started a Race to the Bottom on Basel III," so we will discuss that theme. Pervenche Berès studied at Sciences Po Paris in the late 70s. She entered the staff of the French Parliament, in 1981. She spent a number of years as a staffer there, including as head of staff for President of the French Parliament, Laurent Fabius, from 1988 to 1992. Since that time, since 93, she has been a member of the leading bodies of the Socialist Party. She's been a European Parliament since 94 and has spent 25 years at the European Parliament, which is a very short tenure by the standards of the US Senate, but very significant by the European standards, including as chair of the Econ Committee, the Committee on Economic and Monetary Affairs from 2004 to 2009, and also as chair of the Employment and Social Affairs Committee in the next term. She also, as a member of the European Parliament, Pervenche has been very instrumental in the founding of Finance Watch in 2011, an NGO which is dedicated to checking the power of industry lobbyists in the financial sector in Europe. After she left the European Parliament, she entered the Sustainable Finance Committee of the French Securities Regulators, the AMF. The next year, in 2021, she became the chair of a think tank and a publisher called Association Europe Finance Regulation, the Association on Europe Finance and Regulations, which is based in Paris and is very prominent in the local policy debates. And since early 23, I think, Pervenche, you have been a member of both the Ethics Committee and the Audit Committee, which is really the Risk Committee of the European Central Bank, so back also in the official sector in that capacity. Enough from me, Dan, over to you.
Thanks very much. Thanks very much, Nicolas. I'm just going to share some slides here. I'm, as Nicolas said, kind of outside the policy community per se. I'm a kind of strange little freelance consultant. So I thought I'd make these remarks a bit provocative and kind of a bit sort of contrarian by trying to argue that what we're seeing in the latest kind of round of Basel implementation and the finalization of Basel III, the endgame, is global regulatory divergence. There will be no global consistent implementation of Basel, but maybe that doesn't matter. So clicking on to my first slide, if I can do that. Europe is already materially non-compliant. It is, in my view, likely to be downgraded to fully non-compliant at the next peer review carried out by the BCBS peer review teams. And this has been a bit of an embarrassment for Europe, but frankly, no worse than that. It's not really affected their ability to regulate their own banks. It's not really even affected the position of European banks in the global financial system. And that's how things are. These things are a little bit embarrassing, but they are not real pain points. In terms of the European non-compliance issues, we have the known issue of the treatment of sovereign bonds, which has caused severe practical problems in the past because it caused the doom loop and the excessive holdings of domestic government bonds by peripheral European banking systems. But we also have the Danish compromise on insurance holdings, which is a favorable capital treatment to bank assurance companies.
I think we no longer hear you, or maybe that's only me.
Into the European capital requirements regulations with what they call the European specificities, which is to say the facts about the European economy, which make it so dependent on banks rather than and it kind of unfair that they doesn't even implement Basel at all, for which a full Basel are the global systemically important banks. This is always been a loophole built into the Basel standard. It's always meant to apply to large internationally active banks. However, you can have a bank like Silicon Valley Bank, which was by any reasonable standard large, and which actually had something like 20% of its business outside the USA, and it's not considered a large internationally active bank for the purpose of whether the USA is going to try to apply Basel standards to it. That's always been the sticking point internationally, and it remains the sticking point now that endgame has come in. It really looks like under endgame, almost everything in the USA is not going to be regulated under a Basel standard. The only kind of compromise that the Fed managed to retain in the face of industry lobbying was that some of the really bad aspects of the Silicon Valley Bank failure, like holding government bond portfolios at kind of hold to maturity rather than mark to market value, are going to be abolished. But really, this is going to be still a case in which the vast majority of the US banking system is not subject to international standards. It also includes the first case I'm aware of in which the USA has materially weakened a Basel standard. The capital requirements for operational risk are meant to be based on gross fee income but the US proposal is to base them on net fee income. So, this is clearly a situation in which everyone went into the process thinking that we would have a strengthened global system. And in fact, we have a system which has been selectively strengthened relative to Basel II, but which remains highly globally inconsistent. But I'm going to be a devil's advocate here. What do we actually want from a global banking standard? If we go back to 1987, the old days which only very, very old people like myself remember, when documents from the Basel Committee used to call the town Basel, spelling it in the French way, that only changed in the 1990s. That's why I've got an asterisk on these slides. It's not a typo. If you go back to the cover of the 87 Accords, they say Basel. There was a clear purpose there, really. Everyone was worried about huge undercapitalized Japanese banks funded by domestic deposits and so not subject to any meaningful market discipline, in general buying each other's preference shares, so giving quite misleading pictures of their balance sheets, taking huge amounts of market share in global financial centers. The 87 Accords were meant to put in place a couple of quick and dirty ratios, like the Cook ratio, which is today the risk-weighted asset ratio, just to say there's got to be some limits on leverage and there's got to be some consistency in the definition of capital. There was never any real agreement that we needed total global regulatory harmonization, and in my view, there never would have been. However, 15 years later, we came back to Basel II. By then, they'd updated the spelling of the town, and people had built careers out of ratios. Everyone was in the mood to believe that bank supervision was about ratios. The only people who disagreed were the Office of the Comptroller of the Currency and the FDIC in the USA, who still thought that bank regulation was about on-site supervision. If you believe that regulation is about ratios, then Basel I was completely inadequate. It didn't cover all sorts of things, and it was really crude. So we had this update to turn it into a very complicated, very quantitative ratio-based standard. Unfortunately, 2004 was also pretty much the high watermark of industry lobbying. So, we had to bring in Basel III after 2008, when it was suddenly discovered that internal modeling was not as good an idea as it had previously been thought to be. Outside America, we're still working on the assumption that regulation is ratios and that in order to get regulation right, you need to get the ratios right. That is still not a consensus view in America. And I would argue that it's the USA that's more true to the original idea of the Basel Accords. It is intrinsically difficult to agree a standard that is appropriate for all of the banking business models in the world. That's why the Basel Committee tried to come up with a ratio that would capture interest rate risk in the banking book and fundamentally failed to reach consensus on it. Covering that variety is just not possible with a manageable kind of set of regulatory standards. So what happens these days is that we agree rules that Asia can live with. Europe then massively engineers them and puts in exceptions in order to cover the variety of the European banking system. And America tailors them purely to the largest banks and pretty much ignores everyone else. To my mind, this works. The biggest reason for this is that regulatory arbitrage doesn't work. In fact, there is very little to be gained from a bank by shaving a few basis points off its capital ratios. In fact, it can be argued it's entirely the other way around. The global systemically important US banks have hugely gained over the last 10 years from a perception that their capital is the gold standard. The Jamie Dimon always comes up in results announcements talking about the fortress balance sheet. That's why I think, and I wrote in the Financial Times, it's very surprising that the US banking lobby is lobbying for dilution of the Basel standards, because they're diluting their big intangible reputational assets. The only way that you can really gain international competitiveness through more lax regulation is by pushing bailout risk onto your domestic sovereign. And that's the real difference between the European and the US system. The USA generates Silicon Valley Bank types. The US has a regulatory system which, in my view, is always going to deliver crises not unlike Silicon Valley and Signature Bank. But the USA is capable of clearing up its own messes because it's got the FDIC, it's got a federal backstop, and it's got a system of bailouts in which, the US industry will always talk very strongly against bailouts 9 years out of 10, and then do a huge bailout in the 10th year. Europe is not set up to do that because there is no European deposit insurance system. There is no public sector backstop to the guarantee. And so every crisis in Europe has a strong probability of falling directly on a single sovereign that can't necessarily achieve it without creating a doom loop with its own credit. That's why Europe has to apply the Basel standards far more deeply in its own kind of banking system. And because it has to apply them to every bank in Europe, it then has to dilute them. So my argument here is that the inconsistencies and the implementation failures of Basel are actually just the way that the system adapts the need to have some kind of globally applicable rulebook with the fact that that rulebook just can't do what it needs to do to be applicable in places as different as the German Landesbanks and Wall Street. Regulators will keep on struggling for consistency. This will continue to be an embarrassment in the global forums, but I would argue that the rest of us shouldn't worry too much about that. And I think I am 2 minutes over time, so I will stop right there.
Magnificent. There is an official history of the Basel Committee, which was written by no less than Charles Goodhart. I hope, Dan, you will write the unofficial history if you haven't done that already, because I think it would be well worth it. Pervenche.
First, I have to thank the Peterson Institute for this very timely discussion, and also Daniel Davies for his not only provocative, but punchy and interesting presentation. I think we are here in a world of regulation and of lobbying. And I would say in the world of lobbying, banks are the master, whether in the US or in the EU. So the whole fight we are having around the implementation of the endgame should not come really as a surprise. Daniel, you didn't mention anything about the name. In the US, it's the endgame. In the EU, somehow, some people tried to write down the idea that it was Basel IV. I just prefer to say that it's Basel III, and it's going to be implemented in the EU, except that there's one big caveat, which is it will be implemented on the 1st January 2025, but there's a big caveat with the
Basel review of the trading book.
Yeah, of the trading book, then FTR, that will be a delay for 1 year, I believe, also to allow to find out what's going to happen elsewhere. But on your first point, let me just, I couldn't resist to react on 3 points when you mentioned the fact that there would be a big inconsistency in the EU. First, I mean, when you discuss the whole negotiation in Basel in the EU, there's one big concern because of the use of internal model. As you know, the internal model are much more developed in the EU, and in the US, they have the standard approach. And there's a big thinking that the Basel machine for internal model that would not allow the EU to benefit fully of its capacity to manage risk. The second big discussion is about the scope, because of course in the EU, the scope is much, much wider. I mean, it's been a discussion going on since Basel II, and obviously it's still going on. And we could imagine that this is one good reason for the EU to be able or obliged to develop some kind of SME supporting factors to allow for this big scope, which I would not, nobody should jeopardize this. I think it's a good approach for the EU. And the third thing is in the EU, I think in the mandate of the supervisor, when they are checking the sustainability of a bank, they are not only looking at the Basel, they are also mitigating this with other criteria, for example, on sustainability, which is more and more growing in the risk balance. And so I believe you need to get a mixed. But in the end, I would say I agree with you. The most important thing is to have a place where people, supervisors, discuss, share concerns, and are able to find good solution in a world. And this is where now I'm going to go to my second point, where obviously the question of interconnectivity is a raising issue. I mean, after each crisis, we discover a new link of interconnectivity, and there we are. This is why I think in the end game, the question of the risk-weighted asset has been a hot potato. And this is where now the big lobby is happening on both sides of the Atlantic, or even cross-channel. Because behind the risk-weighted asset, the big candidate are the output floor and the operational risk. And here, as you may know, everybody is counting how much own funds does it mean for your bank. And I have to tell you a little story. Last May, a French banker came to me and told me, come on, Pervenche, you have to know that in the US, the JP Morgan CEO is having a discussion with the president of the Fed to find out how much they would allow the own fund to be increased because of this application of the end game. And there has been some forecast, it would be costly for 24 or 90% for the big US banks. And they had decided, and this was the information I got in May, that the end game would be plus 8%. Now, on the 10th of September, Michael Barr, the vice president of the Fed, has announced that it should be, or it will be, or it would be after everybody has in mind that it will be after the presidential election, a threshold of 9%. So there's still 1% of negotiation margin that I'm sure will be used by all US banks. Facing this, a debate we already had in the EU, who was well implemented, has raised again, because now banks are claiming that it's a non-fair competition, and that and the bias they're using to defend this argument is that this is not consistent with the mandate that was given by the Basel Committee by the G20, because what they say is that the G20 had asked the Basel Committee to upgrade the methodology so that they would be more comparable and more harmonized without increasing the total of own fund needed on the balance sheet of banks. So this is now the big argument reopened. And as you know, French European banks, they would have an increase of 11% in the average, and 15.1 for 8 big banks for these own funds. Maybe in the discussion we will, because I think I will be over time, so I don't want to enter the lesson we should take from the Silicon Valley Bank, but I would really like to have this point in the discussion. But just to conclude, that for me, this game is a dirty game, a dangerous game, because we don't have so many arenas at the international level in terms of multilateralism that is useful, that can work. And I'm among the ones who do believe, and I was happy to read it under your signature, Danielle, that, let me go to, regulation is not a constraint on the financial industry, it is part of the infrastructure. And if we get out of this game, we will go back to crises we have known in the past, and we will not have any damage control tools. So I think we really need to get the right balance. And if I look at some, of course, the lobby of the banks, I know them, but I can also see, I can just quote the French president of the Republic in his speech called Sorbonne II. He said, we need to revise the application of what is done with Basel, okay? And then if I read what the candidate for the financial market in the next commission is saying, she fully agreed that Basel need to be implemented. So this is a good and strong and important point on which we need to base the argumentation. But of course, to open the door for some adjustment. What you put behind adjustment is something we really need to be careful about. So my strong claim, and I think this is where we share a strong view, is that it's not an easy game. It's a game where you have huge lobby on both sides, but where reasonable people need to keep on going in the right direction. Otherwise, we know what happens when this interconnected world gets wrong, and banks are good candidates for interconnection accidents.
Right, so we have a little bit too much consensus, but we'll manage that. Thank you so much, Pervenche. Thank you to both of you for very thought-provoking initial remarks. So I have tons of questions. I'm sure we will also have questions from the audience. I will try to keep it conversational with your help. But first, Dan, I want to come back to this point you made, that the high standards of capital requirements has been a strength for the US banking sector. Jamie Dimon uses it as a marketing device. And now we see the US banks lobbying for weakening that, and the European banks doing the same. Is it that bankers are stupid, or how do you rationalize that?
Well, I don't want to kind of sound like I'm criticizing people so much richer than myself, particularly harshly, but bankers have this tendency to be fooled by their accounting system. In particular, bankers have this tendency to mistake the regulatory capital requirements on a piece of business for the actual capital requirements on that piece of business. And that's, in my mind, just wrong from a mathematical point of view, because we know that the regulatory capital requirements on each individual business add up to the total requirements. That's not a property that the economic capital requirements would have. You know, this is kind of maths that I was taught at business school back in the 1990s. The economic capital always depends on the contribution to the overall risk profile. And because of that reason, I think what's happening is that as the regulatory capital systems get more complicated, people start using them as economic capital systems, and people stop thinking about capital as anything other than a regulatory phenomenon. And that's when, you know, we've had so many warnings from this. I think in his last year as chair of the ECB Supervisory Board, Andrea Enria, at pretty much every speech, was straight out begging banks to stop quibbling over basis points of common equity tier 1 ratio. You know, he was telling them it makes no difference to your business, guys. I think one of the very kind of most impressive things about Dr. Claudia Buch as she's taken over, that she's continued to emphasize that banking supervision is not really about basis points of capital plus or minus. It is about, as Pervenche was saying, the actual risks that are being run. And I kind of worry that the US banks have just fallen into that same trap, and they've directed this huge lobbying cannon at something which actually shouldn't matter so much. You really shouldn't, as a bank chief executive, be allowing someone else's ratio to run your business.
Isn't it even true of Jamie Dimon himself, sorry to name a name, but who had been lobbying against the Basel III endgame in person, even so, he, as you said, he has skillfully used the strengths of the capital requirement framework as a marketing device. So what's happening here? Is that connective dissonance? What is your explanation?
I suspect that it has a lot to do with the fact that if you've got a business that has now got so big it can't grow realistically at any rate other than global GDP, dividend payouts become more of a priority in terms of getting your share price up. And that's where I would expect the lobbying action to be, just in
That's where the
individual
danger
approval.
comes, huh?
Yeah, absolutely.
So, Pervenche, you've told us that the Basel Committee was something worth preserving because it helps the world manage systemic risk. That's my words, not yours, but that's what I heard. You've been critical of the governance of the Basel Committee in the past as a European parliamentarian. I remember you were involved in a number of reports that, questioned the legitimacy of its rules for Europeans from a democratic point of view. Can you navigate us in that tension between the inherent lack of democratic legitimacy of global rules and the fact that we still need them?
Yeah, well, this is the whole global chapter about what are the good rules for globalization. We had a framework in the past that was called Bretton Woods. This is not, it doesn't fit for purpose today, and we are trying piece by piece to reinvent how it should be. And so we are completely divided into trying something and looking for the best. And obviously the Basel is a good candidate for this. One of the reasons I mentioned, one of the strongest point, I think, where we have some concern, but somehow Daniel helped me to resolve the equation, because my concern is when you look at the European landscape, of course, you have very, very different, not only type of bank, but jurisdiction and civil law and failure law. So it makes the whole picture much more complex and different than just the US mainstream driven Basel Committee, which is now the feeling some people have. And the good candidate for this is, of course, the debate about the internal model. I mean, we know that the whole conclusion of the Basel III was a headache because of the calculation of the output floor, which was something the US really wanted to push for. And for the EU, it looked like a diminution of the benefit they had from their internal model. But so the concern is, how much are you able to take into account the diversity of your different landscape? And who is taking the lead to define the rules? And I have to confess that among the lobby I received, or the discussion I have with some stakeholders, to put it more politely, they are always concerned that the figure with which, or the knowledge or the understanding of the logic of European banking is not good enough in the Basel Committee. And so this is why in the end you end up with margin of maneuver of interpretation, I believe, in the different jurisdiction. But for the time being, I have nothing better, so I'm happy to use it, and I'm happy that Daniel is convinced that we need to use it, we need to implement them, that the new commission will push for that. I'm just afraid about this idea about new adjustment, because what does it mean? Where does this bring us in a landscape where once more strong international institution for good regulation are not so numerous? So we are here in a critical example. And when I hear people discussing in mainly not financial stability, forgetting why we had Basel. I mean, Daniel did a very good history of the reason of Basel, and now I think you can also add SVB, the Silicon Valley Bank. Each time you have a lack of supervision, you have a lack of implementation of rules, and you end up with a cost for everybody. And the day after, you forget the cost of the crisis, and you just look at the cost for your bank that is going to diminish your profit. This cannot be. I mean, it's the whole. I mean, if you listen to people, if you don't want to apply Basel, and do you want to go back to self-regulation? Just let's remember what happened when we had the great financial crisis. Come on. And now, if the biggest world is about international competition and what the other jurisdictions are doing just to avoid to do anything, we will have a new crisis.
I failed in my personal duty as acronym police. Dan used two acronyms, the BCBS and LTCBs. That's, of course, the Basel Committee on Banking Supervision and the Long-Term Credit Bank of Japan, of which we saw the logo. Dan, I have another question for you, but I think you want to say something first.
And I think I am going to end up having to write that unofficial history of the Basel Committee, because, I mean, Pervenche is absolutely right here. And the thing is that it's actually Basel that is the anomaly in terms of global harmonization of regulation. If you compare it to insurance regulation or securities regulation, I do know the acronyms there, but I'm not going to say them. It's banking regulation is far more globally harmonized. Why is that? Well, it's because it's all but done in central banks, and central banks had a little club of people who all knew each other, who were all friends with each other, being seconded to each other's organizations, and they had a nice little place that was set up to handle German war reparations under the Versailles Treaty, and for some reason never closed down. And so it provided a room for them all to meet up in and form this committee. It's amazingly undemocratic when you think about it that way, and it operates purely by consensus, and the consensus basically involves the USA discussing with Asia what they're going to force Europe to do. Pervenche mentioned internal models. Securitization, to my mind, is the more drastic example, and it's the one that's about to become more controversial over the next few years. Because if we look at the last crisis, it was hugely driven by a specific US model of mortgage securitization and commercial real estate securitization. Now we're in 2024. The US RMBS, residential mortgage-backed securities, and commercial-backed securities markets are flourishing fine under the new regulatory regime. Europe is in something like its 15th year of trying to come up with a plan to revive the European securitization market, because Basel ended up agreeing a set of rules that the USA could live with just fine because it's got deep domestic fixed income bond markets, and which completely destroyed the market for Europe. And so, unsurprisingly, the European Commission have started saying, and I believe the EBA has now kind of joined them, and I can't remember, but I think the ECB has also said they want to go back to Basel and revisit some of those decisions. And that's a case in which it's just genuinely the fact that this was a US-dominated process that's been applied to a European situation in which it just doesn't fit.
Oh, I have a slightly different question, which is about the European way of applying Basel. And as you both reminded us, the EU applies Basel to all banks. And Dan, you had a theory that, or this model, that this is the reason why Europe is non-compliant, because in order to be able to apply it to all banks, no matter how small, it has to make some adjustments. But then you made that point, which I think is very valid, about a few basis points. So my question to you, and you can give a technical response to that question, if Europe was to apply Basel in a fully compliant way, would that really be harmful in any way to European banks? Or is it just that it would be politically difficult because that's more lobbies to confront, but wouldn't really change anything in terms of the structure of the banking sector, or kind of real life effects? How do you view that? If we were to be in a world in which Europe is fully compliant, what would it change in practice?
Well, if Europe was fully compliant with Basel and then the national jurisdictions were fully compliant with the European regulation, which is another kind of issue, since we've moved from directives to regulations, all of that compliance issues are now the fault of Europe rather than, when I was a young man at the Bank of England, it was very much inconsistent. We had this phrase Italian implementation when it came to talking about the banking coordination directives, as they were then called. I think it would cause problems. Basically, it would cause problems for small German and Austrian savings banks. And small German and Austrian savings banks are actually really important. Something like half of the banking licenses in the European Union are in the country of Germany. And they are small banks which are basically pretty low risk because they shift all of their risk up the chain to the Landesbanks. And although they are low risk, they have certain characteristics that don't really play well with some of the kind of standards which have been drafted for smaller banks elsewhere in the world, some of which are very risky indeed. So there are some things and there are some products that are popular in the European markets which just don't really exist anywhere else. And also, the great sticking point of Europe is it doesn't have a particularly well-developed domestic equity market. It doesn't have all that well-developed a domestic corporate bond market. And so lots more risk ends up on the balance sheets of these small and medium-sized banks in a way that's actually pretty easy to deal with. I mean, I'd put it this way, Nicola. If you applied Basel rules consistently across every bank in the USA, there's a huge number of US banks which would not be compliant. That would require massive consolidation and reorganization of the US banking system. I don't think Europe is particularly different. It would just be slightly different types of banks that had to eat it.
Josh, you made the point, I think, that it was right for Europe to apply Basel to all banks. But why is that? Why wouldn't we do like the US, say, okay, it's for the big banks, we exempt the small German or otherwise, local banks, and then we reap kind of the benefits that the US has from that. Are you sure that the lack of differentiation is in the European interest?
Maybe we need an impact assessment to answer this question. But what I'm quite sure is that somehow it's nearly impossible to compare the US and the EU system. So we had to adapt the scope of implementation of the rules to the difference of the landscape. And in the EU, somehow it's much more heterogeneous than in the US. In the EU, we don't have any European banks. We have big banks, okay?
UniCredit.
Sorry?
We have UniCredit and ING.
No, but so and also this might be a non-politically correct argument, but I know you like it. But if you would only apply the Basel to big banks, you would not hit at all member states. And so this would also introduce a competition argument among banks and member states that would not ease the implementation of the Basel Agreement. And the Basel Agreement for the EU is very critical. I mean, Daniel earlier said that when it came to the Silicon Valley Bank crisis or collapse, the US were able to fix it together, and it would be much more difficult for the EU. I have to admit that still, if the US had a better supervision system or had not laws that had downgraded the scope so much that a bank like SVB was outside scope of implementation of direct supervision, and banks that didn't overcome 6 warnings from the Fed regarding its situation, we would be better off. But I think this is also something you have to take into account, that the risk is too big to play that games. But this brings me to something I wanted to say about SVB that is for me very, very critical and relates to the importance I have for Basel to be a machine working. While the SVB crisis and its impact on Credit Suisse were managed, some of the very good arguments that were made following the great financial crisis were completely forgotten and given up in a daytime when it comes to the bail-in rules or to the hierarchy of the creditors. It's been completely thrown out, and this has happened without any cooperation or real discussion. I'm sure there had been one or two phone calls, but when it's come to the spirit of what we tried to implement since the great financial crisis, that because of interconnectedness, you need to discuss and to cooperate, this really is, for me, something quite puzzling. So it might be that the US have been able to solve quickly the SVB banks crisis, but they have not been helpful at all for the spirit of what should be international cooperation, and not a very good example of what or precedent for what's going to happen in EU when it comes to the discussion on hierarchy of creditors, that hopefully for the time being is not open in the EU, but also on bail-in and also on deposit guarantee scheme. For me, I don't like it.
Dan, I'd like you to get us a bit outside of the US and EU focus and think a little bit of other jurisdictions, and also, starting from where you are, the United Kingdom, but any other you might want to mention. Where are they? Particularly on this debate about where the boundary lies, right? I mean, the US is one extreme, very few banks covered by Basel. The EU is another extreme, every bank, no matter how small, covered by Basel. How are the other jurisdictions navigating that trade-off?
The Russian are out.
Yeah, I mean, I think at the end of the day, it's easy to get hung up on kind of Basel and about regulations. The overwhelming majority of the rules in the Basel Handbook are duplicated absolutely everywhere on Earth because they are just sensible best practices of running a business. If you actually look at the Basel rules numerically, there's a few that everyone talks about and which are controversial. The overwhelming majority of them are just things like you can't have banks owning each other's preference shares because that creates capital out of nowhere. So there's never going to be huge amounts of divergence. The UK has diverged on a couple of EU treatments that it felt was going to be super equivalent. The UK has cut back on some European specificities to do with some quite technical things, but basically to do with things that were in the European rules for the benefit of banks of a kind that the UK doesn't really have. But the UK is never really going to diverge that much.
What about the scope of application in the UK? For example, small local banks, is the UK going to impose Basel on them going forward, or will they exempt?
The UK has a small and strong regime for smaller banks that it's bringing in. I would personally regard that as being basically consistent with Basel, because remember, Basel contains multiple treatments. You have the advanced treatments, and then you have standardized approaches. In general, there's not very many small banks that want to run with high levels of leverage. The problem for small banks in complying with regulatory standards is always the operational cost of putting the reporting systems in place. And so with small banks, there's quite a lot of jurisdictions. The UK is trying to do it now. The EU has so far tried not to get too far away from the principle of one standard for everybody, but it does respect the principle of proportionality in some areas, particularly on market risk, where the kind of highest level reporting standards can be very expensive indeed to implement. So there's actually a lot of flexibility within the standards to do most of what you want to do while staying compatible with the Basel standards. It's the USA that's the real outlier here, because in the USA, we did have things like government bonds trading at 70 cents in the dollar being accounted for as 100 cents in the dollar for purposes of liquidity requirements. We had, all of these strange treatments which were meant to be backed up by a very aggressive program of on-site supervision carried out by the federal banking examiners. And then, in March 2023, we discovered that some of that system wasn't quite as aggressive as they thought it was.
I see a question in the Q&A from Christian Chavagneux, but that question is about resolution, not Basel standards per se. So, Christian, I encourage you to chip in with a question on the Basel standards, but I will be a bit narrow here and not expand the scope too much towards the resolution and the hierarchy of liabilities. Even so, I know it's interesting, but we'll deal with this in other future sessions. Back to you, Pervenche. There's an issue which is kind of nagging into Basel Committee, which is, we said it's US dominated, but actually the EU is massively overrepresented in the Basel Committee, and there are no fewer than 7 countries, individual countries of the Eurozone, on top of the ECB and also the European Commission, who are full members of the committee. I think that even includes Luxembourg, which is systemically important, of course, from a Luxembourg point of view, but not very big from a global perspective. So how do you look at this issue of EU representation in the Basel Committee? Would the EU actually get a better deal in Basel if the ECB was alone there, now that it's basically centralizing all supervisory policy? And how should we think about it? Also from the perspective of the global south, of global governance, of the current tensions we see in the world these days.
Yeah. Thank you for raising this easy question, Nicolas.
You will make friends in a number of member states. That's my purpose.
No, I mean, in an ideal world, of course, you could imagine that the EU should speak with one voice. But I think this also reflects, but you don't have the diversity. I mean, each country is, for the time being, defending its own system, and there's still quite some competition among the EU members. To look at our own homework, I would believe that if we really had a consistent internal system that would be built, we would be easier. But
sorry to interrupt. Is that still true? We're celebrating next week. The day before the US election is the celebration of 10 years of European banking supervision. Is it still the case that we have so much divergence in the way supervisory regulations are applied by the single supervisory mechanism?
No, the supervisory mechanism, I think, is a huge success. And I think the way we've been dealing with the SVB, the consequences of the SVB and the Credit Suisse crisis in the EU is really a demonstration that the SSM, the single supervision mechanism, does work.
Why do we need member states in Basel for something which is the Basel Committee on Banking Supervision? I'm not talking about resolution here. I'm talking about supervision when we have a successful integration in the EU. Sorry to put you on the spot. It's a bit unfair, but just to understand.
No, but I mean, you know me enough to see that I have. For me, it's not a question. For me, it's not a question. But this gives me maybe the opportunity to say that for me, what my concern is to make sure that we still get this working capacity in the Basel Committee to tackle the future challenges. And here I must confess that as chair of this think tank, IOFR, we've just published a debate paper on big tech and financial market, for example. And I know the French supervisory authority contribute also with a new paper on it. And I think this is a hot potato that the Basel Committee need to tackle quite quickly. I understand that Carsten, the BIS chair, somehow said that this would mean changing completely the approach when dividing entity and activity-based supervision. But it's an upcoming challenges. Big tech are taking more and more part in the financial activities. Their interconnection with banks is more than huge. The rapport de force between the two is going to be upside down. And so if we are not serious about this, we will have a next crisis there, because the stability risk is not so big for the big tech, but the part they take in the banking activities might be a risk-based originate a big risk that the Basel need to look at, also because by essence it's going to be a transatlantic issue, because EU banks will be affected by big tech settle in the US. So it's not going to be an easy discussion, I know it. But I think it's a fair candidate for this debate. And the same apply for non-banking financial institution. And here I know there are big call from the FSB, the Financial Stability Board. And I think we need to look at this seriously once more, because my driving word will be interconnectivity. And here it's also something where the interest of EU is to make sure something goes ahead. Whether it should be and I'm fully confident that the ECB could be a very good interlocutor for that.
That, I think, answers the question that was raised by Luis Hernandez Aramburu on whether fintech are taking undue advantage of regulatory differential treatment from banks. We're almost at the end of the hour, but I mentioned the US election, you mentioned the US election next week. Maybe a last question from me to both of you. The Basel Committee just celebrated this year its 50-year anniversary. It was created in 1974. As Trump becomes president, is it in danger? What is the scenario for this piece of global financial regulatory governance going to play out? Maybe Dan first, and then Pervenche will have the last word.
Well, you never know is the only answer I can really give to that, because in the last Trump administration, it was Randall Quarles who was the vice chair for supervision, and Randy Quarles was actually, I think, generally regarded as a pretty constructive and useful contributor to most of the international forums that he worked on. And at the end of the day, the very kind of phenomenon we've been discussing, that the USA has limited skin in the game when it comes to Basel regulations, kind of puts a limit on how much damage kind of even a really destructive US administration could do to the Basel Committee itself. The problem for kind of international banks is that you have to deal in US dollars, you need to have access to the US market, and so a bad regulator or a bad regulatory system in the USA is going to cause problems for you on a much more rapid timescale than anything that happens in Basel. So it's something I think everyone's going to be worrying about, but not necessarily in that specific context.
Pervenche, we need to wrap up, but in a nutshell, how do you view that risk for the Basel Committee?
Thank you for this very political question. I believe this is not, the Basel Committee is not the only field where the question could be raised. My only concern is that I can see that there are some crises, and not the minor one, coming from lack of supervision from a US-based bank. So I hope this would not be aggravated by the outcome of the American elections.
Oh, indeed, a lot of consensus on this session, but consensus on very insightful views. Thanks so much to Pervenche Beres and to Davies for illuminating us on Basel. And as I said, in a month's time, we'll come back to similar themes with Stefan Mingves, which I'm sure will be also worth your time. The next session in the meantime will be on 14th of November. I will host Laura Wu Guiyang, who is an expert in Chinese corporate IPOs and securities regulation. She will tell us on whether the more dynamic companies will keep seeking investors and go public outside of China, or whether that's coming to an end, a very important theme as well. And in the meantime, again, with lots of gratitude to our two speakers, thanks very much for the session and have a great rest of your day.
Thanks very much, Nicolas.